During your working life, you may have contributed to a workplace pension plan offered by your employer or made contribution to your own personal pension plan. These are known as defined contribution pensions. These are not to be confused with state pensions, which require separate contributions from your earnings, that is, from your national insurance contributions. In this video, we're talking about the former, private pensions, and how withdrawal strategies affect them. I've made a couple of videos on state pensions already if you'd like to check them out. Now, the earliest you can access your defined contribution pensions is from the age of 55, rising to 57 in 2028. Then, you'd be faced with the question of how to withdraw cash from your pension pot. You could take all the retirement pot in one go, which isn't a good idea usually. This is because 25% of your pot is tax-free cash, but the rest will be taxed as income. Therefore, withdrawing all the money in one go may push you in the highest tax brackets and could mean a heavy tax bill. So you should be careful there. Another option is that you could take cash as a series of lump sums known as uncrystallized funds pension lump sum, or UFPLS for short. Similarly, 25% is tax-free and the rest is taxed as income. But here, because you can choose how much you're withdrawing, you could be strategic and avoid paying too much in taxes. Besides UFPLS, you could take an annuity which in return for a lump sum gives you a guaranteed income for the rest of your life. In this case, you're trading a sum of money for a guaranteed payment, and some people prefer this steady income as it offers peace of mind. Another popular option is known as the drawdown. Whereas under UFPLS, you have to take your tax-free cash along with your taxable portion. With drawdown, it is possible to just take the tax-free cash and park the taxable portion in a drawdown pot for later use. This withdrawal scheme is also known as Flexi-Access Drawdown, or FAD for short. For example, if you need £250, you can withdraw or crystallize £1,000 from your pension pot. As usual, 25% of that crystallized amount is tax-free, that is £250. The rest, that is £750, is taxed as income. However, because you don't need the £750 yet, you can keep it in your drawdown pot where it is reinvested so it can continue to grow. In the future, whenever you take any cash from the drawdown pot, however, that is taxed as earned income and you will pay tax at your marginal income tax rate. That is 20%, 40% or 45% depending on your circumstances. The other advantage of Flexi-Access Drawdown is that as long as you don't touch the drawdown pot and just use your tax-free cash, you don't trigger what's called the MPAA rules. The MPAA rules, or Money Purchase Annual Allowance, refers to reduced pension contribution allowance of £10,000 per year for the tax year 24-25. Usually for this tax year, you can contribute up to £60,000 into your pension pot and get tax relief. However, if the MPAA rules are triggered, that contribution limit falls to £10,000 per year. So in our earlier example, if you just took £250 tax-free cash through the Flexi-Access Drawdown, you would not trigger the MPAA rules. However, if you took the equivalent through UFPLS, you would trigger it. Again, depending on your circumstances, that may not be an issue. With FAD, you could take all your tax-free cash to fund your living expenses until there's no tax-free cash left. Then move on to your drawdown pot. Now, because it's tax-free cash, this means you end up spending less of your accumulated wealth, whether it be in the pension or drawdown pots. That would be a saving of at least 20% depending on your tax rate. Now, we didn't even factor in your personal allowance, which stands at £12,570 currently. When your personal allowance is taken into account, it means you can actually withdraw a total of about £16,760 tax-free from your pension pot every year. Here's how you can calculate this. 25% of £16,760 is equal to £4,190 as tax-free cash. 75% of £16,760, that is £12,570, is taxed as income. But remember, that's equivalent to the amount of personal allowance, so that's your zero tax withdrawal amount. But let's say in practice you want a higher income, say 20k a year. In that case, you could crystallize the difference and pay a little bit of tax. In that case, you will need to withdraw approximately £20,572. Of that, remember, £5,143 is tax-free cash. Less your personal allowance of £12,570, and you'd be left with a taxable amount of £2,859. Assuming you don't have any other sources of income, that would be taxed at 20%, meaning you'd pay £572 in tax and you'd be left with £2,287. When you add these up, you'd get a £20,000 post-tax income. As mentioned earlier, the defining advantage of Flexi-Access Drawdown is that you can just use the tax-free cash from your pension pot as long as it's available. What that means is that you could withdraw 20k tax-free from your pots, completely tax-free. The easiest way to work this out is to figure out how much tax-free cash you need first of all. Remember, your personal allowance is £12,570, and therefore anything above that will be taxed. In this case, it's 20k minus 12,570, which gives you 7,430 of tax-free cash required. Now, if you need 7,430 of tax-free cash, that means you need to crystallize 4 times that amount. Remember the 75% to 25% ratio. That means you need to crystallize £29,720. But as you only need 20k, the remainder, that is 9,720, is the balance left in your drawdown pot. As you can see, there is no taxable income and therefore no tax to pay. So there you have it, your 20k tax-free income. The only difference is here you've moved more money into your drawdown pot. In this case, there's no additional cash going to the taxman. You save £572 in each tax year, which means your pots remain larger and therefore can compound more. The less tax you pay, the more of the pots remain, the more compounding occurs. More compounding means bigger pots at the end. It's a no-brainer. Or is it? What if I told you that this zero tax strategy could be a mistake? In fact, in my next video, I will show you situations where this strategy puts you in a worse off position than if you use the off-plus approach. So, I'll see you there soon. Thank you for watching, and I'll see you next time.